Big news on 3M. They settled their lawsuit. $10.3 or $10.6 billion settlement. Now, guys, when it comes to companies that have these lingering lawsuits, a lot of times just getting the lawsuits handled, even if it's a big number, can really drive the stock price up. So we're going to sit here. We're going to go through the company's fundamentals. They have a nice dividend. The company's down quite a bit, so we want to check out to see if the company is a buy today. We're going to go through some bull cases, some bear cases, some news on the company. There is something in this video for everyone, whether you're a beginner investor or an advanced investor. Make sure you watch all the way through. We will have something we're going to build up. We're going to talk about the general fundamentals of the business. We're going to go through some analyst estimates. We're going to go through our 8-pillar process. And then we're going to finish with our stock analyzer tool, which will involve us making assumptions about the future for 3M. And it'll tell us what price we need to pay today in order for those assumptions to yield us a decent return. So, in full disclosure, I own the stock. This does not mean you should buy the stock. Do your own research. We're here to teach a process. The goal of this channel is to teach a process because you can apply that process to every sort of investment. So Mo, talk about the settlement.
So I'm going to read it this is from 3M's investor website.
Oh, great.
So 3M resolves claims by public water suppliers, supports drinking water solutions for vast majority of Americans. So the agreement is for $10.3 billion payable over 13 years. So this is for their, I guess, water issue that they were having. This doesn't go into one of the other main lawsuits, was the earplug issue.
Yes, that was a lawsuit.
Yeah, so that one's still going on. And there's news on that one as well. It's from June 9th. 3M reinforces preparedness to defend combat arms earplug litigation docket. So this is a big one. 200,000 current cases in there, 175,000 plaintiffs.
Oh, geez.
Let's see. I want to see if there's a number. I don't know if they would put it on their website, but I'll find it.
For those of you who are doing the math, $10.3 billion over 13 years is $800 million per year. Okay? Now, if you look at their cash flow, in the last 5 years, they've averaged $5.5 billion of free cash flow, $4 billion in the last year. They pay $3.3 billion out on their dividend, which is a huge dividend yield, 6.2%. So the question people are going to ask, and they should be asking, is that dividend safe? Okay, well, $800 million a year, that's a lot. And that takes up 20% of the last year's free cash flow and about 15% of their 5-year average. Big number, especially considering they pay out such a big percentage of their free cash flow in dividends. So is it possible they cut their dividend, which is already attractive at 6.2%, in order to pay for that settlement? Maybe so. The other thing is, guys, look at the stock price. The all-time high was $260. And that was only 5 years ago, and it's currently at $97. So the 6.2 dividend yield is so attractive, they could easily cut that in half, and it's still 3.1%. And they save $1.65 or $1.7 billion a year in dividends that they can use to buy back cheap shares and pay this settlement off.
So this one would also be between $10 and $20 billion for the earplugs. And I don't remember who it was, but we have somebody in our community that is involved in the lawsuit.
Really? Yeah. Involved in how?
They were in the military. They used the earplugs.
Ah.
Yep.
They're actually a recipient,
correct.
A plaintiff.
Correct. They're one of the 200,000 plaintiffs.
I thought you were going to say they were one of the lawyers involved. Let's get them on the show. So guys, look at this. The current PE is 9.9 and the 5-year P is 9.9 as well. This is why I want the company buying back shares. Guys, when it was at $260, even if today's price was $260, that would take the PE right here to about 25. You don't want companies buying back expensive shares. You want them buying back cheap shares.
Especially a company like them that's so big, and where's the growth going to come from?
Yeah. Where's that growth going to come from? Solid, stable margins, 6.3, 6.4%, gross margin of 43. Look at this return on invested capital, 14.5%, Mo. This means they get a good return on the money that's invested in the business. Now, the question is, do they have a lot of areas to invest that money? If they have a lot of areas they can invest and grow their earnings by 14.5% on every dollar they invest, they should not be paying a dividend. But the fact they are, and the fact that their growth is not very exciting, shows that they don't have many prospects for reinvestment, which is okay. But why are you paying a dividend? By the way, I'll say this. This is going to be a very unpopular opinion. If I were the head of the company, I would cut this out completely and just buy back shares. That's what I would be doing. Why pay out a dividend when you have such cheap shares? Why? This doesn't make any sense to me. Let's go look at the 8 pillars, Mo. Now remember, if you have our software, guys, you can customize your pillars up to 12, and there's like 4 quadrillion different variations, but I personally stick to the 8 originals, and there's 2 X's here. Net income growth is down, free cash flow growth is down, but everything else is a check. In the cash flow statement, oh wow, they've actually been net sellers of, so guys, in our cash flow statement, they're going to show acquisitions and dispositions. When it's a negative, it means they acquired. When it's a positive, it means they were net sellers.
They're selling off.
Wow, they're actually selling off some assets and still, okay. Now, this could be an opportunity because of these lawsuits, because of people getting negative on 3M, to buy a great company at a good price. Now, I want you guys to know, if you do your own research and you choose to buy it, you're never going to buy at the bottom and you're never going to sell at the top. So you have to be ready for the stock to go further down. And when it goes further down, the hard part is, for investors, the numbers are the easy part. The hard part is to sit there and say, my thesis is the same, but Mr. Market's just being emotional and I want to buy cheaper shares. For example, if this $97 becomes $50 and you've invested all the way down, that's hard to see sometimes, but that's what it takes to be a successful investor. So Mo, let's go over some of these before we do our analyst estimates and our stock analyzer tool. What are some bull and bear cases for 3M?
Sure. So since 2006, bull case, 3M has spent a quarter of its free cash flow on acquisition. So again, this can be looked at as a good thing or a bad thing, depending on how they do with the acquisition. Courts are allowing 3M to pay the forever chemical settlement over time. So again, I think it goes back to this one too. You get to pay it over time. It's not a lump sum, $10 billion you need to pay year 1. And I'm sure they're going to be doing the exact same thing for the earplugs issue.
Yeah, probably.
Don't you think? Bear cases, 200,000 cases filing, various dockets for the litigation in the earplug trial. As we were talking about, one of our subscribers is in that. Since 2016, 3M's gross margin has plummeted due to the loss of pricing power and operating efficiencies.
I mean, look at that. You're right.
You can see this graph that Justin will put on the screen.
It was at 50%.
Yep.
And now it's at 44%.
Yep. There's nothing in here, bull or bear, that makes me sway one direction or the other.
Yeah.
Does it to you?
No, I don't.
I mean, obviously, it doesn't.
I don't like it when companies want to grow only through acquisitions, but I'm not saying that's happening here.
And also, I mean, that might be the place that they see growth through from 3M.
Yeah, maybe so.
Is saying, hey, we can't grow on our own. Let's acquire to grow.
Let's look at these historical stock prices.
Or at least try to. Let's see here. History of drastic moves. And the point of us showing this is you see that there are many times throughout history, good times, bad times, whatever, where the stocks fell big time. So you can see that, guys, even stocks, a powerhouse company like 3M, they have big falls in their history.
Well, look at the 10-year chart, Mo. They're down 14% over the last 10 years. Now, if you were along the way and you were collecting a nice dividend of 3 to 5% along the way,
exactly.
You're still in the positive on it.
Exactly.
But guys, this is what happens when stocks are overpriced.
And this is a company that is in everybody's household.
Yeah. So could this be an opportunity to buy a great company at a great price? I don't know. So one of the things I want to show you guys is analyst estimates. Now remember, we take analyst estimates with a grain of. The analysts are just as affected by the market's movement as everybody else. They want to be as close to the market as possible. They want to be as close to their group as possible. But right now, analyst estimates for earnings per share estimated for this year of $8.68 a share, going to $11.47, growing by decent amounts. But guys, it's not going to make any gangbuster moves. You're not buying a company that's going to grow 20 or 30% a year, or even 10% a year. You're buying a stable company that's going to pay a dividend, hopefully buy back cheap shares. That's the play on 3M. Okay? Let's look at their revenue estimates. Again, look at these boring revenue estimates, Mo.
Yeah, they're boring.
I mean, 3 to 4% a year. That makes sense. It's just a boring company, but you can make a lot of money off of boring companies if you pay the right price.
Right.
And you can lose a lot of money off of exciting companies if you pay the wrong price. And that's what we're trying to teach here. The main thing we're trying to teach is it's possible to overpay for a good thing. All right, so That leads us to our stock analyzer tool, the most popular part of our website. Used 1.3 million times in 2022 by our thousands of users. So if you like this, you like all the tools involved with our software, you can get this, everythingmoney.com. One of the big things here is our real estate calculator. We are in the final weeks of real estate calculator being offered as part of your membership included. By the end of this month, it's going to be a separate tier altogether that's going to be much more expensive. So if you sign up now, you get this real estate calculator forever included in your package, $1 per day. We have a trial right now, $7 for 7 days, $1 per day. Come check it out. It's well worth it. You get all these tools. You get our stock analyzer tool. You get our community of thousands of investors. You can go in there and chat with people about your investment ideas. So everythingmoney.com, go check it out. So Mo, let's do a 10-year analysis on 3M.
Okay.
Now, again, guys, whatever these numbers come out at, if they come in and it's all green, you need to do your own research. That is the key here. So, Mo, give me some revenue growth numbers.
How about -2 on the low?
Whoa, okay.
What if they have declining revenue?
Okay.
I mean, they're kind of almost in that phase, don't you think?
Sure.
0 and 2?
Okay. Profit margin.
I would almost go 16% across.
Let's do it. Free cash flow.
I would almost be inclined to do the same. I see their free cash flow in the last year has fallen, but historically, they're around 16%.
Okay.
What do you think?
Let's do that. And by the way, we rarely do that, guys.
Yeah, very
the key
rarely.
here is, but it's rarely this consistent.
And to me, like, this is a consistent company.
Yeah. A consistent company that he wants to put -2% revenue growth on for the low side.
They'll consistently keep their margins, but their revenue might decline.
Maybe. And guys, this is why we're doing low, middle, and high assumptions. It's about coming up this like wide range and figuring out if it's reasonable or not. Now, I mean, PE.
Look at their net income.
What should their PE be, Mo?
Look at their net income. From 2014, it was 31
You mean
billion.
revenue?
I'm sorry, their revenue. 31 billion to 33.5 billion. I mean,
I know.
So,
but we're also in a more inflationary environment, which will help companies like this.
Yeah.
That's part of their gross margin and the pricing power they didn't have.
But we were also in a banger economy for 10 years.
Yeah.
So, all right.
Okay, PE.
PE. How about 12, 14, and 16? Maybe a little high. 11?
See, I actually think I'm fine with that.
Okay.
Guys, so this is the difference between Mo and I. I would have never put -2 in. He would have. I'd have put 0, 2, and 4. Mm-hmm. I wouldn't have put 12 here. I'm like, this is 3M. I'd put like 14, 16, and 18. The differences.
Do you think they can do 4% revenue growth for the
Well,
next
if we
decade?
haven't, listen, if
you
we
think
have,
they'll keep with inflation?
if they can do, yeah, Mo, everything they make is things that we need and use. You know what I mean? It's not like, I mean, you see all the things they make. It's everyday household items that you're telling me that over long periods of time, they aren't going to grow with inflation. I think they are. That's my opinion. And again, this is why we have these this is the art of investing. This is the issue. Now, for our desired return, guys, this is essentially where you put your margin of safety in. The higher your assumptions, the more margin of safety you need. Therefore, the higher return you need, right? So Mo, give me your desired annual returns along the way.
I'd probably go 10, 11, and 12 for this one.
Okay.
What do you think?
So I wouldn't have done this, but I like what you did here. If I'd done my higher numbers, I'd have done 10, 12, and 14.
Higher, yeah.
And think about what I just said. If I'd put in higher numbers here, I would have wanted a higher return. But Mo's basically sitting there saying, listen, I beat this thing up. I don't need to make 15% returns. I would want to own 3M at these low numbers.
Mm-hmm.
So we're going to hit the analyze button. Guys, a bunch of numbers are going to pop up. The great news is you can add these to your watch list just by clicking a quick check mark, a quick plus mark next to the number, add it to your watch list, and the software will update you and send you a message through email, through the phone app, and through the website telling you the stock hit its price. So here we go. Boom. All right, a low price of 88, a high price of 116, a middle price of 101. If you paid today's price and the low assumptions occur, you're going to make 8%. Middle assumptions occur, you're going to make 11.5. High assumptions occurs, you're going to make a 15% number. I don't think, like I said, do your research, but look at where we're at. It's on my watch list at 90, only because at that point I have to sell some more options at lower prices. So guys, thank you very much. Again, everythingmoney.com. Check it out. $7 for 7 days. You get all this software. Thank you for your time.